Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of the PFIC, otherwise known as the PFIC, Passive Foreign Investment Company. We do have another presentation, or a few presentations on this topic, but as of late, due to a bunch of misinformation and misguidance that is going on the World Wide Web, we've had taxpayers inquiring to us with questions and situations which they shouldn't be in. So let's work through the basics, realizing this is a simple guide. It's an introductory guide. It's by no means completely comprehensive, but for those of you that may have foreign mutual funds, ETFs, or other pooled funds, it may help shed some light on what needs to be done. The PFIC is the Passive Foreign Investment Company. Typically, someone thinks of a PFIC and they think, oh, they have like a foreign holding company, or they have a foreign rental property company, something like that. But unfortunately, a lot of taxpayers get stuck in the PFIC matrix for simpler reasons, like they have a foreign mutual fund or an ETF. So in order to be a PFIC, there's two tests, and you only have to meet one, either the income test or the asset test. So a common example is the mutual fund. And when I say mutual fund, I'm referring to all types of similarly situated pooled funds, ETFs, CCOVs, things like that, and foreign, okay, not US-based. It could even be a foreign mutual fund based on a U.S. stock market, still foreign fund. Let's say it's based in Luxembourg or something like that. So a common example would be the mutual fund. And why is that? Because a mutual fund, in and of itself, it's typically incorporated in its own little entity with its own managers and advisors. And I'm not talking about like a mirror fund. A lot of insurance policies, for example, they may have a mirror fund in which they create their own internal kind of sort of funds to mimic or mirror markets that are out there, but it's not really a fund per se. That may be excluded. It depends. But mutual fund ETFs, they fall into the PFIC category, and so that means that there's the additional reporting, there's the additional headache of the tax. And so the reason behind PFICs is that, especially with like a mutual fund, let's say, right, a foreign mutual fund, the IRS, the U.S. government, they have no idea what's going in that fund. That fund is not U.S. based. It doesn't have to meet the U.S. regulations and requirements and the 90% rule and things like that. So who knows what's going on? The IRS, they want their piece, right? The tax gap is the way it is, and it keeps getting bigger, especially the international tax gap. And so they've really been cracking down on these types of situations. So with a PFIC, if you've got the PFIC, then from a tax implication, you may lose out on things like long-term capital gain, qualified dividends. Instead, everything is taxed at the highest tax rate available, except the current year, which is taxed. This is for excess distributions, which we'll get to in a minute, but most people don't know about the elections. So oftentimes they'll be taxed at a high tax rate, way higher than they would be in their domestic equivalent fund, and they have to pay interest on the time that the money's been sitting in there, and it gets into one big headache, right? So let's take a step back now, baseline perspective. Let's assume that you have a foreign mutual fund or ETF or whatnot, right? I keep doing that, right? A foreign fund, and you own it, and it's a PFIC, forgetting any exceptions, exclusions, limitations. So the first thing is the reporting. You have to report on the FBAR, Foreign Bank and Financial Account Reporting, FinCEN Form 114. It's become more known in recent years. You don't have to go through the regulations or the code. You could just look at IRS's publication 5569, which nicely summarizes in about 10 pages what's FBAR reportable, what's not. Pooled funds are clearly in there. The complexity of the reporting can be determined by whether or not you have multiple funds and if those funds are in an account, if you own them individually. For example, let's say you have a DMAT account in India, and in that account you've got 60 funds, right? You've got HDFC, L&T tax, etc., but they're all under one account number. Well, typically you can just report the account, the maximum balance, aggregate total of all of those funds, even the non-funds. You may also have bank accounts in there, stock, things of that nature. But you can report it that way, which isn't so bad. Versus if you own all of the funds individually, that's a different scenario. Right now, you've got to list each fund specifically. If you have 25 or more funds, then you may have to do the supplemental sheet. It becomes a much bigger headache. You got to do it every year, etc., etc. Now, typically, you would do an 8938 for this type of asset, but if you have to do the 8621, then generally you don't have to do both, right? So you do the 8621, and you have to identify each fund specifically, because you have to know the basis for each fund so that when you sell it, you're able to calculate what the quote-unquote gain would be, okay? So reporting, you've got the FBAR. You could probably sidestep the 8938 if you're doing the 8621, and the 8621 requires you identify each PFIC separately. Now, this is where it could begin to get more complicated. Maybe you have a holding company overseas, a CFC, controlled foreign corporation, then you've got GILTI and Subpart F and all that kind of jazz, and it crosses over with the PFIC. Typically, the CFC rules will trump the PFIC rules, but you should talk to a board-certified specialist at that time. You don't want to jump to any conclusions. There may be some limitations or exclusions or exceptions that you can rely upon. Now, if you know you have the PFIC right when you get it, then you may be able to make an initial election, like a QEF, which is a qualified electing fund, or an MTM, which is a mark-to-market. Now, typically the QEF is going to be better than the mark-to-market from a tax perspective, but it does require some cooperation from your foreign financial institution. Important tip, be careful before reaching out to the institution, asking them for that kind of information. You may lead on that you're a U.S. person. They may not want you in the fund anymore, because then they know they have some FATCA reporting that they may not be doing or don't want to do in the future. If you did not make the election in the first year you had the fund, then you may be able to make a late election, but that doesn't mean you just kind of mark it off on the 8621. You have to actually go back and do a purging election. It's a late election, so you do the excess distribution, shadow calculation, and then going forward, you can do the QEF or the MTM. There's also some exceptions. If you didn't make those elections, not everyone has to file the 8621 and deal with this. You only have to. The exceptions would be the two main ones. Okay, are if the value is under 25,000 or 50,000, depending if you're married filing joint or married filing separate. Depending on whether you're relying on the instructions or the regulations, you either have to prepare page 1 or the top of page 1 for the 8621 or not. There's also, if it's in a treaty country, in a pension type fund trust, then you may be able to qualify to not have to parse it out. Unfortunately, this is only in treaty countries. It's regulation 12984T something, but it doesn't apply to non-treaty countries. So your Singapore CPF, your Malaysian EPF, things like that. You wouldn't be able to use that exception for the treaty. Let's look at a few common examples we see often, right? Jane is a lawful permanent resident who lives in the U.S. Before coming to the U.S., she invested in a lot of mutual funds. They're growth funds. They don't pay anything. So she didn't think twice about them, learned recently that they're supposed to be reported. Now she has to go back and report those. Why? She's a U.S. person. She has foreign mutual funds. She's over the FBAR threshold. She's over the 8621 threshold. No exceptions apply. She has to report those. Another common one is foreign pension plans. If you have in a SIP, let's say in the UK, or superannuation in Australia, then you may qualify. You've put on the FBAR, but you may qualify for the treaty exception. Now, like I said, if you're in Singapore or Malaysia where there's no treaty, Taiwan, then you would have to unfortunately identify each one in the 8621 unless another exception, exclusion, or limitation applied. The CFC PFIC crossover happens a lot with holding companies and real estate rental companies. Common example, person is a foreign person, and when they were a foreign person, they amassed a pretty nice fortune, and so whatever country they reside in has the rule, and a lot of foreign countries do, where if you have it in a holding company, you're not paying the same tax or the same tax rate as if you own it individually. That unfortunately, that person becomes a U.S. person. It's like, whoa, not only do you have a controlled foreign corporation, it's like category 1 and 5, and you've got GILTI, you've got the one-time repatriation tax, even though right now that's at the Supreme Court and more. You've got a lot going on, Subpart F, so something to consider. Now, there's some exceptions to this, the high dollar exception, high tax exception, but oftentimes these are in countries where you're not paying tax, so those won't be applicable in your case. If you're just hearing this now and realizing you're out of compliance, please take a step back. It's nowhere near as bad as the garbage you'll read online, the fear-mongering, the scaremongering. You're going to go to jail, written in big red letters. Most of the time, these cases can be resolved pretty straightforward. using one of the amnesty programs. The main programs are the streamlined filing compliance procedures, delinquent FBAR, delinquent international information return submission procedures, although since November 2020 they've changed a bit. You can always make a reasonable cause statement, noting late elections for PFIC, the reasonable cause is different, and it's almost impossible to qualify. You may, but it's not the same as doing your other kind of reasonable cause for FBAR, something like that. We've got a ton of information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.